Hey everyone, me Kevin here. Yesterday, multiple of you in my course member discussions asked me about what I thought about the quote, biggest indicator of a stock market crash. Now naturally, I wanted to know what this indicator was. I like being aware of dangers as well as positive indicators coming. That way I can make sure to flip-flop when I need to. Well, I was read the following quote about stock market crashes, and I want to know what you think. A quick note, by the way, if you do want private live streams and to be a course member, you get lifetime access, only one payment. There is a V-Day coupon code down below, and V-Day's already on Monday. All right, folks, here's the quote. When you see a recession coming, it's most likely led by unemployment. When people lose their jobs, earnings go down, people cut back. Today's the total opposite. It's a freaking booming economy today. We're off to the moon. Those are two quotes. The "we're off to the moon" part is pretty close to this. But this was the thesis here, is that, okay, when you see a recession coming, it's most likely led by unemployment. And I thought to myself, okay, so maybe we should look at charts on unemployment to see if unemployment's going up, because actually it sounds really exciting. My gut says unemployment's actually really low. If anything, it's falling. And it makes me want to invest everything I have and flip-flop, and that way I can also be on the rocket ship that goes off to the moon. See, I know that everyone's spending money like crazy. I know people are getting paid like crazy more than ever before. People are getting paid so much so that household checking account balances have never been this high. It's amazing. Things are booming right now. Look at earnings from the fourth quarter. Everybody's spending all the money they got. Parks at Disney had their revenue beat expectations 17% because people are spending so much money. People feel so rich that 50% of people are upgrading to skip the line. You don't usually see that kind of stuff. The per capita spend at Disney is the highest it has ever been before. That means even though you could have less guests going to Disney World or Disneyland, people are spending more money than ever before. The booming economy, it's true. So when they say that a recession coming is most likely led by unemployment, I'm curious about this. So I think to myself, okay, well, I'm a numbers guy, okay? I like statistics and facts and logic. Unfortunately, those things are not extremely popular on YouTube, but that's okay. Let's go ahead and look at the chart, and let's see if we can corroborate this thesis. So this here is a chart of our unemployment rate in the United States. The gray lines here are when there were recessions, and the spikes in the blue lines here are spikes in the unemployment rate. So let's go ahead and zoom into, let's say, 08. Obviously, the pandemic was a little interesting. We could zoom into the pandemic, too. So it looks like we actually were in a recession while the unemployment rate was still 3.5%. Let me hide myself there. Look at this. We actually entered into a recession when we went from 3.5% to 4.4%. But we were almost done with the recession by the time the unemployment rate skyrocketed. Okay. What about 2008? Maybe that's an anomaly. Okay, 2008. Looks like the recession started technically over here in the early half of 2008. We had a stock market crash in September of 2008. The unemployment rate had gone from 5 to 6%. But wait a minute. It didn't actually skyrocket until the stock market, until beyond, like after, when the stock market already bottomed in the first portion of 2009. It looks like it actually peaked in October of 2009, well after the stock market had already substantially recovered. Here in the dot-com bubble, looks like the crash was really here at end of 2000, 2001. Unemployment rate didn't really start going up until the end of 2001. This is interesting. It looks like the same that's true of the 2020 recession, the pandemic recession, the recession of 08, the dot-com bubble, the 1990s recession, the early 80s recession, the 70s recession, the we got that one, both of the recessions in the 80s there, and then in the 70s. Wait a minute. Every single time there's a recession, it looks like the unemployment rate goes up after we go into a recession. So, but wait a minute. The quote that I'm being told everybody's freaking out about and being so excited about is, when you see a recession coming, it's most likely led by unemployment. But wait a minute. According to the statistics, it actually looks like a recession happens first, and then unemployment goes up, which kind of makes sense because if you're a business and you think things are booming, why would you lay people off? It's only when we're in a technical recession. That's when businesses appear to start cutting back, at least based on the facts. Let's see if we can learn a little bit more here. Oh, what's this? Investopedia, lagging indicators. They can clarify and confirm a pattern that is occurring over time, but lagging indicators can only be known after the event. That doesn't make them useless, but they're known after an event. The unemployment rate is one of the most reliable lagging indicators. Oh, crap. So we probably shouldn't be looking at the best indicator of a crash ever, the unemployment rate, because then we'd be really far behind the curve. If the unemployment rate rose last month and the month before, it indicates the overall economy has been doing more poorly and may continue to do more poorly. Right. The unemployment rate is a lousy recession indicator. If you want to time the next recession, the unemployment rate is the worst place to look. The unemployment rate was low when the market crashed in September of 2008. We just saw that on the chart. And kept rising way after the recession ended in March of 2009. Remember, the Fed bailed us out in Feb of 2009. The unemployment rate is such a bad indicator of how well the economy is doing that it did not start increasing until 5 months after the official start of the recession of December 2007. Here's some more research as well. What's this? The unemployment rate is often used to indicate economic strength, but is also a lagging indicator. Low unemployment is the result of economic growth, not a precursor. Huh. Okay. So, wait a minute. Then we're getting duped when we're being told if we just look at the unemployment rate, we're good. Now, that's not to say that if unemployment is low, the opposite is true, recession is coming, right? It just means that if individuals are telling us, hey, Kevin, everything's fine, there can't be a recession because unemployment is low, and unemployment is a leading indicator, it looks to me like whoever's saying that is either wrong, uneducated, or trying to deceive people into thinking that we're actually heading to the moon when that's not a fact or potential rationalization to say we're even remotely heading to the moon. Now, other things could say we're heading to the moon, but this is not one of them. Because the last thing we want is to have a stock market crash 25 to 40% and then see the unemployment rate go, oh, we're in a recession, but wait a minute, we're already down 25 to 40%. Keep in mind, recently the stock market has only bobbed around 5 to 10%. So what are actual leading indicators that are relevant to us today? Leading indicators, things that tell us something before it's likely to happen, not after. Well, how about an unaccommodative Federal Reserve that can't lower interest rates and won't lower interest rates because they're already at zero. So they can't accommodate us with lower interest rates. They've printed enough money, digitally printed enough money, so they can't print more money. We actually have an unaccommodated Fed that's so far behind the curve, businesses are raising prices, creating more inflation than ever before because they realize that inflation is not transitory. That was a big mistake. And because we have inflation happening so much so right now, the Fed has to fight it. And the Fed's already told us they don't care about our stock prices to the extent that they affect jobs and inflation. They care most. Jerome Powell was literally asked this in the last meeting, so don't kid yourself. Right now, he does not care about stock prices. He still thinks stock prices are elevated. Jerome Powell is most worried about fighting inflation. And if that means taking a little bit from the juicy wage market and dealing with the inflation issues, then that's what they're going to do, especially since a wage price spiral has started to happen. The last labor report showed that wage growth is up 8.8% on an annualized basis, which is faster than the inflation rate of 7.5%. That means that people are actually getting paid more, indicating, more than inflation, indicating that a wage price spiral has begun. The director of the University of Michigan Consumer Sentiment Survey says that now the wage price spiral is actually decoupled from supply chain issues, meaning that even if supply chain issues start getting better, the wage price spiral could just take over. Margin debt is 60% higher than at any point in our history before. If we had any kind of bumps in the road in the economy, Congress is unlikely to be able to do anything to bail us out. Why? Because right now, Republicans believe the entire reason we're facing problems is because of the inflationary spending of Democrats. Meaning it's unlikely that for at least the next 2 years, until potentially, certainly not this midterm election, I expect Democrats to get reamed, it's unlikely that over the next 2 years, we're actually going to see anything happen. We're going to have a lame duck Congress. So we're not getting bailed out by the Fed. We're not getting bailed out by Congress. We're on our own here, folks. At the same time, we're in a rising inflation environment, rising price environment, which sure leads to higher profits for businesses, but that doesn't matter if multiples for businesses go down because the Federal Reserve is jacking up rates to potentially high and aggressive levels, creating fear in the market, leading potentially things like precious metals, which have kind of been lagging, to go up, and stock multiples to come down. Another leading indicator is that the yield curve has flattened substantially fast over the last 8 weeks. The flattening of the yield curve could eventually lead to an inversion of the yield curve, which is one of the best leading indicators of a recession. And we're barreling right towards that indicator inverting. So shoot, if somebody is telling you that look how much our economy is booming, look how low unemployment is, you got your head in the sand. You're being lied to. Now, that just because the economy is booming and just because unemployment is low does not mean we are definitely going into a recession, right? The other indicators I talked about are risk factors for a recession. So you can't say, oh, well, we're in a booming economy. What's next? Recession. Well, sure, eventually. That's always going to end up being true. Eventually. So we have to look towards other leading indicators to tell us if we've got danger ahead. But if somebody's telling us, don't worry, we're definitely not going into a recession because look how much people are spending, look how low unemployment is, they're lying to you through their teeth to get more subscribers because they're uneducated, because they want to raise money for their fund and collect more fees from you, and they're deceiving you into a false sense of security. Don't look at today's spending, don't look at today's low employment to determine whether or not we are heading to a recession. These are not indicators. Get educated on better indicators. And if you want to subscribe to the channel, I'll keep bringing them to you. Thanks so much for watching, and folks, we'll see you in the next one. Bye. And check out those courses down below with that V-Day coupon code, and then you'll learn everything that